Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. I beg to our respected lecturers, Dr. Farah and Dr. Wan Zamri. Today, our group one consists of Nur Baida, myself, Jas, and Ustad Rahman. We are going to do a presentation about surplus distribution. Next slide. Okay, this is the content for today. First, we are going to do some introduction, and then we're going to talk about operational process. After that, we're going to talk about Takaful operational framework, and then Islamic Financial Service Board, AOF Sharia standard, and then we're going to end with some conclusion. Next slide. Let's start with the introduction. So let's begin by knowing what is surplus distribution. Surplus refers to the excess of the total premium contributions, which consists of underwriting surplus and investment income paid by the policyholders during the financial period over the total indemnities paid in respect of claims incurred during the period, net of Retakaful or reinsurance, and after deducting expenses and changes in technical provisions. If you look at the formula at the bottom, surplus equal to risk and investment fund, deduct all claims payable, deduct reserve, deduct any cost approved by Sharia Committee and Board of Director. So surplus distribution is the process of sharing the surplus between the Takaful operator and its participants at the end of the certificate period following an agreed sharing ratio. Surplus is a Takaful's unique feature, whereas in conventional, there's no surplus distribution. Next, I pass the floor to my teammate, Ustaz Rahman.
Okay, thank you very much, Josh. Before we go deep further on the discussion about the surplus distribution, let us understand first what is the modus operandi of Takaful model based on Wakalah contract. Okay, based on this illustration, we can see that the first stage, customer will pay the contribution under the Takaful scheme, and then the contribution will be divided into two, agency fee and Takaful fund. Okay. During the financial year or financial period, if the participant make a claim to the Takaful operator, the Takaful operator will honor the claim and pay based on whatever cost related. What we want to highlight here is on the stage number 9, whereby at year end, the surplus is distributed to the participant. In principle, underwriting surplus under Wakalah model should be distributed to the participant only. However, based on current industry practice, in a modified Wakalah model, the surplus is shared among the participant and the Takaful operator. Okay. For let me bring to the calculation, a little bit calculation. You can see here, this is the Takaful payment from the participant, and from this contribution, let's say 10 million, 80% from the total contribution will go to the Takaful fund, and then 20% from the Takaful, from the contribution will go to the Takaful operator as a Wakalah fee. Then 10% out of the Takaful fund will be invested, of which the Takaful operator also as an investment manager will invest in the Sharia compliant venue, and then the Takaful fund will increase from 8 million to 8.8 million. Okay, let's see here in terms of the operation. Okay, the Takaful operator will pay the claim, and then minus the reserve, and then minus the Retakaful. and whatever amount from this operation will consider as the surplus. From this amount, uh, it will distributed among the participant and the company. Okay, I pass to the my colleague, Faida.
Thank you, Ustad. So now let us look into the formula and the example on how to calculate the surplus sharing. So the formula is surplus payment is equal to surplus sharing rate times total contribution received minus total charges, then minus the withholding tax rate. So the surplus sharing rate is based on the approved surplus sharing of the each Takaful operator based on the approval by the Syariah team. So, as an example, we have a certificate that expire with an expiry date of January 2019, and then the product category is a motor. Type of customer is individual customer. So there's no claim made on this certificate. So this is how we calculate the surplus sharing. So the contribution received is 500 ringgit. So the total charges is 40 ringgit. That is inclusive of the service tax and stamp duty. And then the surplus sharing rate is 5%. Withholding tax is 8%. And then this is how we calculate the surplus sharing payment, the gross surplus sharing payment, which is 500 from the contribution received. We minus the total charges of 40 ringgit, and then we times with the 5% surplus sharing rate, so equivalent to 23 ringgit. So this 23 ringgit, then we have to times the withholding tax, which is 8%, equivalent to 1 ringgit and 84 cent. Then the 23 ringgit minus 1 ringgit 84 cents, so we get the surplus sharing of 21 ringgit 16 cent. So next slide, pass back to my teammates.
Okay. Just to share about the issue of surplus distribution. Um, Generally, we understand that the surplus will be among the Takaful operator and the participant only. But we want to highlight one of the Sharia Advisory Council on Bank Negara Resolution on 31st July 2018. In case of the Takaful operator bankrupt or fail, okay, PIDM will take over the operation and the liquidation part. And whatever amount excess after deducting the necessary uh, expense will be absorbed or will be adopted by the PIDM. Okay, so we can understand the surplus is not limited to the uh, between the Takaful operator and participant. It also can go beyond that between the Takaful operator and PIDM. Okay, thanks. Baida can continue on the.
Okay, so now I will continue on this Takaful operational framework. So this Takaful operational framework was issued by Bank Negara on 26 June 2019 that aim to achieve operational efficiency of Takaful business and sustainability of Takaful funds, thereby safeguarding the best interest of the Takaful participants. So, according to this framework, TOF framework, the Takaful operator must manage the operation of Takaful funds to ensure that the funds experience is within the assumed pricing of the Takaful product. Okay, and then this is how actually surplus are determined. It is based on full valuation of liabilities as certified by the appointed actuary and the financial accounts of the licensed Takaful operator that are fully audited by an external auditor. So next point is um, the surplus is only available after claims and other outgo of the funds such as Retakaful contribution being met. Then only after observing any other prudential requirement specified by the bank. And then the last one is based on generally accepted actuarial principles and is in a manner which ensures fair treatment of the different groups of Takaful participants. Okay, next point, surplus to be distributed is recommended by the appointed actuary. Um, and then surplus distribution is in line with the specified policies and the underlying Sharia contract. Then the last one, surplus distribution is made when there is no deficit and will not create adverse financial implication on the PRF or result in the deficit of the PRF. Okay, so go to the next slide. So, just now, we mentioned that uh, it is an actuarial responsibility on this surplus distribution. So these are the main responsibilities of the appointed actuaries of the Takaful operator. So there are two main responsibilities. First one is um, assess the strength. The actuary must assess the strength of the Takaful funds to ascertain the extent to which it would be appropriate for surplus to be distributed such that the long-term sustainability of the Takaful fund is not affected. Okay, this is important for the sustainability of the Takaful operator. And then the next one is it is refrain from recommending the distribution of surplus if in the if in the appointed actuary professional judgment, the surplus should remain in the PRF as a buffer to maintain the ability of the Takaful funds to meet future liabilities or Takaful participants' reasonable expectation not specifically provided for in the actuarial valuations. Okay, next slide. So this is how actually the manner on how the surplus may be distributed to the Takaful participants. So there are, based on the Takaful operation framework, there are four manner on how the surplus can be distributed. First is by retain the distributed surplus. This one is the amount shall be made available and to be paid upon claim, maturity or surrender. So meaning that the Takaful operator will just retain the distributable surplus and it will only be made available upon the claim, maturity or surrender of the certificate. And then the next one is the accumulated distributable surplus. This one, the Takaful operator will accumulate the distributable surplus in the PIF investment or saving of the individual Takaful participant and payable upon claims, maturity or surrender. Okay, the third one is direct payment. So direct operator will pay the distributable surplus directly to the bank account of each individual Takaful participant. And then the last one is donate. The Takaful operator will donate to charitable organization in the case where Takaful participant agree to forego their rights to the next distributable surplus. Okay, the next slide. So, okay, this is some of the example and sample on how surplus clauses in the Takaful certificate. So, the first one is from the Etika General Takaful. This one is the private car certificate. So we can see here that this is the the clause that extracted from the certificate. So the surplus from general Takaful fund will be determined annually and will be payable for annual certificate, blah blah blah. Okay, and then next is this one is from Takaful Malaysia Berhad. This one is for Takaful MyFlex CPA. Okay, the Etika is for the private car certificate. This one is for Takaful MyFlex CPA. And then the distribution of surplus is stated here is 50% of the distributable surplus arising from the GTF as determined by the operator Takaful Malaysia will be distributed to the eligible participant in the form of cashback in accordance to clause 12 of the certificate. Yeah, so and then the last one is from Great Eastern Takaful Berhad. This one is for the certificate that known as Takaful Usahawan. So they have like quite details of how they underwrite their surpluses. Okay, so pass back to my teammates for the next slide.
Thank you, Sister Baida. Now let's talk about International Financial Services Board, also known as IFSB. According to IFSB, policyholders have the exclusive right to underwriting surplus. This means that the shareholders do not share in the surplus because it belongs to the policyholders collectively, as defined in the Takaful Agreement. Any unutilized balance is set aside for future risk provision as advised by the actuaries. This is an important aspect of surplus sharing and distribution because it ensures that the Takaful operator has sufficient reserve to meet future claims. If the Takaful surplus exceeds the required provision, the central bank may allow sharing of the surplus between the Takaful operator and policyholders whose policy is active. This sharing of surplus must be approved by the central bank and based on the advice of actuaries. Takaful operators are required in some jurisdictions to have a clear written policy on surplus distribution. In others, they may determine by referring to the recommendations of their Sharia advisor. Most RSAs, or known as Regulatory and Supervisory Authority, stated that their primary focus is on the solvency examination, which is primarily intended to examine the strength of the PRF. This is to maintain an acceptable solvency position in the PRF. Uh, is required to manage the fair expectation of the participants. Next slide. Okay, the basis for determining and allocating the surplus of or deficit to the participants and the shareholders must follow prescribed accounting standards such as IFRS and IOF. Furthermore, the Sharia Supervisory Board and the Takaful Operator Board of Directors must also endorse the policy. This ensures that the surplus sharing and distribution is transparent and consistent with the international accounting standard. It also ensures that the policyholders receive their fair share of any surplus generated by the Takaful operator. In the event of deficiency in the Takaful fund, the Takaful operator is expected to provide an interest-free loan to the Takaful fund to cover the deficiency. Next slide. Okay, there are several forms of contract that govern the relationship between the participants, policyholders, and the Takaful operator. The most widely used contracts are the Mudarabah, which is profit sharing contract, and Wakalah, which is agency contract. In a Mudarabah model, the Takaful operator acts as Mudarib, or known as entrepreneur, and the participant as Rabul Mal, or known as capital provider. The contract specify how the investment profit and surplus from the Takaful operation are to be shared between the Takaful operator and participants. Losses are borne solely by the participant as the providers of the capital, on the condition that the operator is free from any misconduct and negligence actions. And in that case, the Mutarib is not entitled to receive any compensation for his effort. In Wakalah model, the principal-agent relationship is used for both underwriting and investment activities. In underwriting, The Takaful operator acts as an agent on behalf of the participants to run the Takaful fund. All risks are borne by the fund and any operating surplus belongs exclusively to the participants. The Takaful operator does not share directly in either the risk borne by the fund or any surplus or deficit of the fund. Instead, the operator receives a set fee called a wakala fee for managing the operation on the participant's behalf, which is usually a percentage of contribution paid. However, the operator's remuneration may include a performance fee charged against any surplus as an incentive to manage the Takaful fund effectively. The investment of the Takaful fund is also based on wakala contract, whereby the operator charges the participant a fee in exchange for service rendered. Next slide. The surplus may be invested for the account of the policyholders, provided the Sharia provisions regulating such investment are observed. This ensures that the surplus is used in a manner that is consistent with Islamic finance principles. The party undertaking the investment is entitled on the consideration specified for this purpose, which is the percentage of investment profit in the case of Mundarabah or the amount of the fee in the case of agency. It is to be noted that according to the above, in the case of Mundarabah, only the investment profit is to be shared, not the entire surplus for the period, which includes both the underwriting surplus and the investment profit. That's all for IFSB. I pass to my teammate, Ustaz Rahman.
Okay, thank you very much, Yes. And the last Sharia standard setting bodies is the IOP. So, IOP use the term Islamic insurance instead of using Takaful. In Islamic insurance, the main objective is achieving cooperation among the members of society, rather than generating profit from the insurance operation. The definition of Islamic insurance, according to IUP, is very close to the mutual insurance or cooperative insurance. Okay, according to IOP Sharia standard, contribution paid by the participant is solely owned by the participant pool, unlike the TOF, Takaful Operator Framework, which allow the Takaful operator to get some portion from the surplus. As we can see in the example from 3 Takaful operator in Malaysia, from Etika, Takaful Malaysia, and Great Eastern, they put in the certificate that 50% from the surplus will be shared among the parties. Okay. The concept of tabarruk is applied for the contribution payment, and it creates a prospective owner of the fund shall benefit in case of the excess. Okay, that's why under Sharia standard number 26, IOFI clearly mentioned surplus distribution shall benefit the participant. For example, accumulation of reserve, because the reserve will be utilized in the future. Okay, reduction of the contribution. If let's say the surplus for 2023 is higher, so the contribution from the participant in 2024 will be lesser. Or the participant can give their consent, upfront consent, to donate the surplus for charitable purposes. Okay, and can be distributed among the participants. And IOFI also emphasized that the Takaful operator is not entitled to any portion of the surplus. Okay. Then the insurance surplus is part of the asset of the insurance account and should be disposed of according to what has been stated in the Sharia standard. Okay, distribution of surplus or part thereof among the policyholder should be one of the following form. provided that the selected form is explicitly mentioned in the regulation or in the certificate. Distribution
Distribution
of
of
surplus
surplus.
among the policyholder in proportion to their respective contribution. This is regarding to the, in case of the Takaful operator, want to identify for those who make a claim, they will not entitled for any surplus. And for participant who did not make any claim through the financial period, they are entitled for the contribution. So it's more on operation, and you need to the Takaful operator need to segregate between participant making a claim and participant did not making any claim. And regardless whether the policyholder has received indemnity during the financial period or not. Okay. Distribution of surplus among the policyholder who have not received indemnity during the financial period. Distribution of the surplus among the policyholder after deducting amount of indemnity they received during the same financial period. And the last one, distribution through any other method approved by the Sharia Supervisory Board. So we can say that all the Sharia standard setting bodies put the condition that the distribution of surplus must be reviewed and approved by the Sharia committee of the institution. Okay, I will pass to my colleague Baida for the conclusion.
Okay, from the study that we made on the Takaful Operation Framework, IFSB, and also IOP, this is some of the conclusion that can be made. First one, surplus distribution in Takaful is a crucial aspect of the Takaful Operational Framework. Then the distribution of surplus funds is governed by Sharia principles and regulatory guidelines to ensure fairness and compliance with Islamic finance principle. The third one, all participants are entitled to receive surplus distribution even if they make a claim during a protection period, with the distribution being proportionate to the amount of the claim. And then next one is the Sharia Supervisory Board of the Takaful Company is responsible for validating the information and approving the mechanism of distribution as well as the amount to be paid to the recipient. And then it is important for the Takaful company to maintain a solvency position that is acceptable to manage the reasonable expectation of the participant. So this is where the rules of the actuaries just now. And then the next one is the distribution of surplus funds prior to the full repayment of card vary between the Takaful operators, and the distribution of investment income from investment made by Takaful operators, mainly through a murabaha arrangement, is made according to the predetermined ratio. And then IOP Sharia standard emphasize the cooperative nature of Islamic insurance and the importance of achieving cooperation among the members of the society rather than generating profit from the insurance operations. So in overall, this from this study, it can provide insights into the principle and practices governing capital distribution in Takaful that highlight of Sharia compliance, fair distribution, and the role of regulatory bodies in overseeing the process. So that's all from our team. Thank you so much.
Assalamualaikum warahmatullahi wabarakatuh.
Assalamualaikum.